Two of the largest technology companies on Earth just wrote nine-figure checks to the same startup within days of each other. Amazon committed $3.3 billion to Anthropic. Then Google followed with $4 billion. Combined, that is $73 billion flowing into a single private AI lab that is not yet public, does not yet have the computed needs, and just publicly admitted its flagship developer tool spent a month degrading in quality, while the company initially blamed its own users. That tension is the story, not the dollar amounts. The question worth sitting with is this. If Anthropic is already struggling under the weight of its own demand, why are the two largest cloud providers racing to pour more fuel on that fire? And why does Anthropic keep signing infrastructure deals with all three hyperscalers simultaneously, instead of consolidating with one? The consensus answer is that this is a straightforward AI arms race. Big tech fears being left out of the next platform. The investments secure preferential infrastructure relationships. That framing is not wrong, but it misses the structural logic underneath, which is considerably more interesting. Amazon's $33 billion commitment comes with a detail that most coverage glossed over. The $100 billion AWS spend-back clause is not Amazon billing Anthropic for compute that already exists. Most of the infrastructure it references has not been built yet. The chips have not been fabricated. The power plants feeding those data centers are still under construction. The physical buildings take 18 to 24 months minimum to complete at scale. What Amazon actually purchased is priority position in a queue for capacity it intends to build. The logic inverts the normal transaction. Amazon is not selling Anthropic a service. Amazon is guaranteeing Anthropic a spot in infrastructure that only gets constructed because Anthropic committed to absorb it. The deal creates the supply it promises to deliver. This matters because it reveals something about compute markets that the investment headlines obscure. Compute is no longer a commodity. TSMC's advanced packaging capacity is booked into 2027. A 1 gigawatt data center requires the power draw of a small city, and utilities respond in years, not quarters. When demand triples in 4 months, Anthropic's revenue run rate moved from $9 billion to $30 billion between late 2025 and April 2026. And supply takes 3 to 5 years to catch up, the entity that controls future capacity controls future AI output. Amazon paid $33 billion to be that entity for Anthropic. Google followed 4 days later for the same reason. Amazon's Trainium chips carry a specific structural advantage in this race. Trainium 3 already delivers 50% lower training and inference costs versus GPU alternatives, according to customer reps. Trainium 4, still 18 months from broad availability, has already attracted advance orders. That is how supply-constrained the market is. Customers are committing to chips that do not yet exist. Here is the part that most commentary on this deal is getting wrong. Anthropic is not Amazon's captive. It is not Google's captive either. Anthropic has active infrastructure commitments with all three major hyperscalers simultaneously. AWS handles primary training. Google Cloud runs on Vertex AI. Microsoft Azure hosts Claude through Foundry. Anthropic itself describes Claude as the only frontier AI model available across all three of the world's largest cloud platforms. That is not hedging. That is deliberate multi-cloud distribution. The implication is that Amazon and Google are not bidding for exclusivity. They are bidding for volume share within a deliberately non-exclusive arrangement. Anthropic is using hyperscaler capital to build out its own compute base while preserving competitive leverage over all three providers. Neither Amazon nor Google can price Anthropic out of a rival platform without risking the entire investment thesis. The second thing most coverage is missing is what Alphabet actually holds beyond the $40 billion check. Alphabet is estimated to own approximately 14% of Anthropic at current valuations. With Anthropic's potential IPO approaching, that stake alone could represent several $100 billion in unrealized value, depending on public market reception. Alphabet is simultaneously an infrastructure provider, an equity holder, and a competing model developer through Gemini. That tri-directional exposure is structurally different from Amazon's position, and it creates an asymmetric upside path for Alphabet that the $40 billion headline does not capture. Google Cloud also holds a competitive advantage in custom silicon through its tensor processing units, co-developed with Broadcom. TPUs are currently ahead of Trainium in the custom ASIC race, with Apple, Meta, and Anthropic itself as customers. The Anthropic investment deepens a relationship that Google's cloud division was already winning on technical merit. Two scenarios are worth tracking as this plays out over the next 18 months. In the first, Anthropic's compute capacity problem gets resolved faster than the market expects. Amazon's near 1 gigawatt of combined Trainium2 and Trainium3 comes online by year-end as committed. Cloud code stabilizes, enterprise customer cancellations reverse. Anthropic approaches its IPO with $30 billion in annualized revenue, accelerating growth, and demonstrated infrastructure reliability. In that scenario, both Amazon and Google look prescient. AWS monetizes Trainium at triple-digit growth rates. Alphabet's equity stake appreciates sharply. The $73 billion resolves into one of the better capital allocation decisions in recent tech history. In the second scenario, Anthropic's infrastructure strain is more structural than the engineering postmortem suggests. The Claude Code degradation was attributed to 3 engineering missteps, but the company simultaneously acknowledged that demand has stretched infrastructure at peak hours and is rationing its most powerful model, Mythos, to a select group of large enterprises. If the real constraint is physical compute and not software configuration, the capacity commitments from Amazon and Google do not solve a near-term problem. They solve a 2027 problem. In that window, developer trust continues to erode. OpenAI gains ground, and Anthropic enters its IPO with a credibility overhang it has to price through. The recovery path in the second scenario runs through Anthropic's enterprise base. Over 1,000 enterprise customers now spend more than $1 million annually on Claude, double the count from February. 8 of the Fortune 10 are customers. That density of large account relationships creates revenue stability that is not easily reversed by developer sentiment alone. If Anthropic holds its enterprise base through the compute transition, the IPO window likely holds. The evidence leans toward that outcome, but only if the near 1 gigawatt commitment actually materializes on the timeline Amazon announced. What makes this convergence point unusual is that both Amazon and Google face the same binary. Either the compute comes online and both win, or it does not and neither investment thesis holds. The bidding war framing implies rivalry. The structural reality is that both hyperscalers are exposed to the same single execution risk, whether Anthropic can absorb the capacity without losing the developer loyalty that made it worth $380 billion in the first place.